And I would like to just spend just a couple of minutes giving you a little perspective on how you might think about investments as opposed to the tendency to focus on what's happening today or even this minute as you go through. And to help me in doing that, I'd like to go back through a little personal history, and we will start. I have here a New York Times of March 12th, 1942. I'm a little behind on my reading. And if you go back to that time, it was just about 3 months since we got involved in a war which we were losing at that point. The newspaper headlines were filled with bad news from the Pacific, and I've taken just a couple of the headlines from the days preceding March 11th, which I'll explain. It's kind of a momentous day for me. And so you can see these headlines. We've got slide 2 up there, I believe. We were in trouble, big trouble, in the Pacific. It was only going to be a couple months later that the Philippines fell, but here we were getting bad news. We might go to slide 3 for March 9th. I hope you can read the headlines anyway. The price of the paper is 3 cents, incidentally. Let's see, we've got March 10th up there, a slide. When I get to this advanced technology of slides, I want to make sure I'm showing you the same thing that I'm seeing in front of me. So anyway, on March 10th, when again the news was bad, full clearing path to Australia, and it was like the stock market had been reflecting this, and I'd been watching a stock called City Service preferred stock, which had sold at $84 the previous year. It had sold at $55 the year before, early in January, 2 months earlier, and now it was down to $40 on March 10th. So that night, despite these headlines, I said to my dad, I think I'd like to pull the trigger, and I'd like you to buy me three shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. Well, let's take a look at what happened the next day. Let's go to the next slide, please. And it was not a good day. The stock market, the Dow Jones Industrials broke 100 on the downside. Now they were down 2.28%, as you see, but that was the equivalent of about a 500-point drop now. So I'm in school wondering what is going on, of course. Incidentally, you'll see on the left side of the chart, the New York Times put the Dow Jones Industrial Average below all the averages they calculated. They had their own averages, which have since disappeared, but the Dow Jones has continued. So the next day, we can go to the next slide, and you will see what happened. The stock that was at 39, my dad bought my stock right away in the morning because I'd asked him to, my 3 shares. And so I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37, which was really kind of characteristic of my timing in stocks that was going to appear in future years. But it was on what was then called the New York Curb Exchange, then became the American Stock Exchange. But things, even though the war until the Battle of Midway looked very bad, and if you'll turn to the next slide, please, you'll see that the stock did rather well. You can see where I bought it, 38 and a quarter. And then the stock went on actually to eventually be called by the City Service Company for over $200 a share. But this is not a happy story, because if you go to the next page, you will see that well, as they always say, it seemed like a good idea at the time. So I sold. I made $5 on it. It was again typical of behavior. But when you watch it go down to 27, it looked pretty good to get that profit. Well, what's the point of all this? Well, we can leave behind the city service story, and I would like you to again imagine yourself back on March 11th of 1942. And as I say, things were looking bad in the European theater as well as what was going on in the Pacific. But everybody in this country knew America was going to win the war. I mean, it was, we'd gotten blindsided, but we were going to win the war, and we knew that the American system had been working well since 1776. So if you'll turn to the next slide, I'd like you to imagine that at that time you had invested $10,000, and you put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500. Now I would like you to think a while, and do not change the slide here for a minute. I'd like you to think about how much that $10,000 would now be worth if you just had one basic premise, just like in buying a farm, you buy it to hold throughout your lifetime and you look to the output of the farm to determine whether you made a wise investment. You look to the output of the apartment house to decide whether you made a wise investment if you buy an small apartment house to hold for your life. And let's say instead you decided to put the $10,000 in and hold a piece of American business and never look at another stock quote, never listen to another person give you advice or anything on the sort. I want you to think how much money you might have now. And now that you've got a number in your head, let's go to the next slide and we'll get the answer. You'd have $51 million. And you wouldn't have had to do anything. You wouldn't have to understand accounting. You wouldn't have to look at your quotations every day like I did that first day. I'd already lost $3.75 by the time I came home from school. All you had to do was figure that America was going to do well over time, that we would overcome the current difficulties, and that if America did well, American business would do well. You didn't have to pick out winning stocks. You didn't have to pick out a winning time or anything of the sort. You basically just had to make one investment decision in your life. And that wasn't the only time to do it. I mean, I could go back and pick other times that would work out to even greater gains. But as you listen to the questions and answers we give today, just remember that the overriding question is, how is American business going to do over your investing lifetime? I would like to make one other comment because it's a little bit interesting. Let's say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you, and you'll get that constantly throughout your life. And instead you'd use the $10,000 to buy gold. Now for your $10,000 here, look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, I mean, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset. In other words, for every dollar you have made in American business, you'd have less than a penny of gain by buying in the store of value, which people tell you to run to every time you get scared by the headlines or something of the sort. It's just remarkable to me that we have operated in this country with the greatest tailwind at our back that you can imagine. It's an investor's haven. I mean, you can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. But if you own a cross-section of America and you put your money in consistently over the years, there's no comparison against owning something that's going to produce nothing. And frankly, there's no comparison with trying to jump in and out of stocks and pay investment advisors. If you'd followed my advice, incidentally, or this retrospective advice, which is always so easy to give, if you'd follow that, of course, there's one problem about it. Your friendly stockbroker would have starved to death. I mean, and you could have gone to the funeral to atone for their fate, but the truth is, you would have been better off doing this than a very, very, very high percentage of investment professionals have done or people have done that are active. It's very hard to move around successfully and beat really what can be done with a very relaxed philosophy. And you do not have to know as much about accounting or stock market terminology or whatever else it may be, or what the Fed is going to do next time and whether it's going to raise rates 3 times or 4 times or 2 times. None of that counts at all, really, in a lifetime of investing. What counts is having a philosophy that you stick with, that you understand why you're in it, and then you forget about doing things that you don't know how to do. So with all those happy words, we will move on and start the questioning, and we'll start with Carol.
Hello, this is Xiao from Wuxi, China, Southwood Capital. And being in the marketing for 12 years, wish you and Charlie good health, so we could see you both run the meeting for 12 more years.
Thank you.
Quick question. We know both you and China delegations, US and China delegations are in China for intense discussion on so-called trade war. Let's go one step beyond the trade war. Do you think there's a win-win situation for both countries, or the world is just too small for both to win, and we have to revisit your 1942 chart again? Thank you.
Thank you. I'd like to just mention one thing. In August, I'm going to be 88, and that will be the 8th month of the year, and it's in a year that ends with an 8, and as you and I both know, 8 is a very lucky number in China. So if you find anything over there for me, this is the time we should be acquiring something. All those 8s.
Will do.
The United States and China are going to be the two superpowers of the world, economically and in other ways, for a long, long, long time. We have a lot of common interests, and like any two big economic entities, there are times when there'll be tensions, but it is a win-win situation when the world trades, basically, and China and the U.S. are the two big factors in that. But there's plenty of other citizens of the world that are involved in how this comes out. And there's no question, and the nice thing about it in this country, I think, is that both Democrats and Republicans basically, on balance, believe in the benefits of free trade. And we will have disagreements with each other. We'll have disagreements with other countries on trade, but it's just too big and too obvious for that the benefits are huge, and the world's dependent on it in a major way for its progress. That two intelligent countries will do something extremely foolish. We both may do things that are mildly foolish from time to time, and there is some give and take obviously involved. But U.S. exports in 1970 and U.S. imports in 1970 were both about 5% of GDP. So here we were selling 5% of our GDP and buying up 5% of our GDP, basically. Now, people think we don't export a lot of things. Our exports are 11 and a fraction percent of GDP. They've more than doubled as a share of this rising GDP. But the imports are about 14.5%. So there's a gap of 3% or thereabouts. And I would not like that gap to get too wide. But when you think about it, it's really not the worst thing in the world to have somebody send you a lot of goods that you want and hand them little pieces of paper. I mean, because the balancing item is if you have a surplus or a deficit in your trade, you're going to have a surplus in investment. And so the world is getting more claim checks on the United States. And they to some extent, they buy our government securities, they can buy businesses. And over time, you don't want the gap to get to be too wide because the amount of claim checks you are giving out to the rest of the world could get a little unpleasant under some circumstances. But we've done remarkably well with trade. China's done remarkably well with trade. The countries of the world have done remarkably well with the trade. So it is a win-win situation, and the only problem gets to be when one side or the other may want to win a little bit too much, and then you have a certain amount of tension. But we will not sacrifice the world. I mean, we'll not sacrifice world prosperity based on differences that arise in trade. Charlie?
Yeah, well, I think that both countries have been advancing. And of course, China is advancing faster economically because it started from a lower base, and they've had a little more virtue than practically anybody else in the world in having a high savings rate. And of course, a country that was mired in poverty for a long, long time and that assimilates the advanced technology of the world and has a big savings rate is going to advance faster than some very mature company like Britain or the United States. And that's what's happened. But I think we're getting along fine, and I'm very optimistic that both nations will be smart enough to realize that the last thing they should do is have any ill will for the other.
Okay, Becky, quick.
This question comes from David Rolfe, who is with Wedgwood Partners and has been, the company has been shareholders in Berkshire since 1989. The stock is currently the largest holding in their stocks, 18 stocks. He asks this question. Over the past 2 years, you have listed the individual fund-to-funds performance from protege partners. When will you start showing the annual performance on $25 billion that Ted and Todd manage? Can you state if either Ted or Todd has beaten the S&P 500 index over the last 5 years?
Both. We'll probably never report their individual performance, but you can be sure that I have an enormous interest in, as does Charlie, in how much we think they contribute to Berkshire, and they've been terrific. They not only have the intellect and the record, but they are exceptional human beings, and Todd has done a tremendous amount of work, for example, on the medical project, and Ted is. I've given him several things, and he's done them better than I can do them. So the record since inception, and I'm measuring it. Ted came later than Todd, a year or so later. But the record since inception is almost identical, both for the two managers from their different inceptions, and matching the S&P. And they've received some incentive compensation, which they only get if they beat the S&P. And as I say, they're just slightly ahead. That really hasn't. It's been better than I've done, so naturally I can't criticize it. They were two very, very, very good choices. Charlie?
You did report it in a previous year. You just didn't do it this year. But now you have your report.
Well, yeah. Well, I would. The problem that all of us has is size. It's harder to run even $12 or $13 billion, frankly, than it is to run $1 billion. And if you're running $1 million or something of the sort, it's a whole different game. You'd agree with that, wouldn't you, Charlie?
Of course.
Yeah. Okay. Just like any good lawyer, you never ask them a question unless you think you know the answer they're going to give. Okay, Gary.
Okay, Warren, this question comes from a Berkshire shareholder who says they've been a shareholder for 10 years. I should say this may be one of the most pointed questions I've ever received for you.
But you've elected to give it, though, anyway.
But I did. The shareholder writes, I have watched the movie every year at this meeting when you testify in front of Congress on behalf of Solomon as the symbol of what it means to have a moral compass. Investors are increasingly looking to invest in companies that are socially and morally responsible. So I was disturbed when you were asked on CNBC about the role that business could play in sensible policies around the sales of guns. You said you didn't think business should have a role at all, and you wouldn't impose your values on others. I was even more surprised when you said you'd be okay with Berkshire owning shares in gun manufacturers. At this meeting years ago, you said you wouldn't buy a tobacco company because of the social issues. The idea that Berkshire would associate with any company as long as it isn't illegal seems at odds with everything I think you stand for. Please tell us you misspoke.
Well, let's explore that a little. Should it be just my view, or should it be the view of the owners of the company? So if I decide to poll the owners of the company on a variety of political issues, and one of them being whether, Berkshire Hathaway should support the NRA. I don't. If a majority of the shareholders voted to do it, or if a majority of the board of directors voted to do it, I wouldn't accept that. I don't think that my political views. I don't think I put them in a blind trust at all when I take the job. And in the election of 2016, I raised a lot of money. In my case, I raised it for Hillary, and I spoke out in various ways that were quite frank. But I don't think that I speak. When I do that, I don't think I'm speaking for Berkshire. I'm speaking as a private citizen, and I don't think I have any business speaking for Berkshire. We have never at the parent company level, we have never made a political contribution. I may go, and I don't go to our suppliers. I don't do anything of that sort where I raise money either for the school I went to or for a political candidate I went to or anything else. And I don't think that we should have a question on the GEICO policyholder form. Are you an NRA member? And if you are, you just aren't good enough for us or something. That I think I do not believe in imposing my political opinions on the activities of our businesses. And if you get to what companies are pure and which ones aren't pure, I think it is very difficult to make that call. I think with that response, I'm almost afraid to call on Charlie, but go ahead, Charlie.
Well, obviously, you do draw a limit, Warren.
Yeah, we
all
did.
kinds of things,
Yeah.
which are beneath us, even though they're legal. But we don't necessarily draw it perfectly because we've got some sort of supreme knowledge. We just do the best we can. And certainly we're not going to ban all guns surrounded by wild turkeys in Omaha.
Hi, good morning, Mr. Buffett and Mr. Munger. My name is Steffi Yu from Horizon Insights, a China-focused research firm based in Shanghai. So I have a lot of mutual fund clients in China who are very young, relatively younger, and they manage a smaller portion of funds. So my question is, if you only have $1 billion in your portfolio today, how would you change your investments? Would you consider more investment opportunities in emerging markets such as China? Thank you.
Yeah, I would say if I were working with $1 billion, I would probably find within a $30 trillion market in the United States where I understood things better just generally than I do around the world. I'd probably find opportunities there that would be better, incidentally, by some margin than what we can find for hundreds of billions. But I wouldn't, there's no way I'd rule out emerging markets. There was a time 15 years ago or so when just because it was kind of interesting and it took me back to my youth, on a weekend I went through a directory of Korean stocks and I bought, and these were small stocks. Well, they were small by the standards of either Korean or American business. They were big companies, but I found 15 or 20 and that were statistically cheap and bought some of each one myself. And there are opportunities with smaller amounts of money to do things that we just can't do. And but my first inclination always would be to comb through things in the United States, but I'd comb through in other countries. I probably wouldn't get into very small markets because there can be a lot of difficulties even in market execution and taxation, a lot of things. You can find, if you can't find it in America and China and Britain and a few other places, you probably aren't going to find it someplace else. So you may think you found it, but it may be a different game than you know. Our problem is size, not geography. Charlie?
Well, I already have more stocks in China than you do as a percentage, so I'm with the young lady.
Okay, well, you want to name names? Do these stocks have names? Or?
No, I don't.
Carol.
This question, and
I should just add one thing. You will find plenty of opportunities in China. Charlie would say you've got a better hunting ground than even a person with similar capital in the United States. Would you agree with that?
Yes, I do.
Yeah. So, And in a sense, it's logical that should be the case because it's a younger market, but still a large market. So that markets probably work toward efficiency as they age. Japan had this very strange situation with warrants being priced out of line and all of that 30 years ago. And people notice after a while and it disappears, but there can be some very strange things happen in markets as they develop. I think you'd agree with that, Charlie, wouldn't you?
Absolutely.
Yeah. Jonathan?
This question comes from Keely and actually is directly about the issue of moats. He notes that Elon Musk this week on his Tesla earnings call said the following, quote, "I think moats are lame. They are like nice in a sort of quaint vestigial way, and if your only defense against invading armies is a moat, you will not last long. What matters is the pace of innovation. That is the fundamental determinant of competitiveness," unquote. So Warren, it seems the world has changed. Business is getting more competitive, pace of innovation, technology is impacting everything. Is Elon right?
Let
Well,
me answer that one, Warren. Elon says a conventional moat is quaint, and that's true of a puddle of water. And he says that the best moat would be to have a big competitive position, and that is also right. You know, it's ridiculous. Warren does not intend to build an actual moat. Even though they're quaint.
Yeah. There's certainly a great number of businesses. This has always been true, but it does seem like it. The pace has accelerated and so on in recent years. There's been more moats that have become susceptible to invasion than seemed to be the case earlier. But there's always been the attempt to do it. And here and there are probably places where the moat is as strong as ever. But certainly you can work at, certainly should be working at improving your own moat and defending your own moat all the time. And Elon may turn things upside down in some areas. I don't think he'd want to take us on in candy, but and we've got some other businesses that wouldn't be so easy to. You can look at something like Granimals out there in the other room, and it won't be technology that takes away the business in Granimals. It may be something else that catches the young kid's fantasy or something, but there are some pretty good moats around. Being the low-cost producer, for example, is a terribly important moat. And something like Geico, technology has really not brought down the cost that much. And I think our position as there are a couple of companies that have costs as low as ours, but among big companies, we are a low-cost producer, and that is not bad when you're selling an essential item. Okay, Greg.
This question is from Daniel Kane of Atlanta. Your annual letter this year pointed out that Berkshire has become a leader in real estate brokerage in the United States. Congratulations. That is a significant feat in less than 20 years. But let me mention a sticky point. If fees charged by stock market active managers are a drag on investor performance, I would argue that real estate commissions are no different and perhaps more detrimental, especially when one considers the lifetime effects of large, foregone upfront cash flows and the power of compounding interest. I would be pleased to hear your rejoinder on the points I've raised.
Well, the purchase of a home is the largest financial transaction for a significant percentage of the population that they make, and a lot of people need a lot of attention, and you can show a lot of houses before you sell one. I would say this: if you look at our close to 50,000 agents now, I think they make a good living or decent living, but I would say that people who manage money make a whole lot more money with perhaps less contribution to the welfare of the person that they're dealing with. So I don't think that there are unusual profits involved in being a real estate agent. I don't think there are unusual profits involved in the ownership. We like it because it's fundamentally a good business. But here we are doing 3% of all the real estate transactions in the United States, and we're making maybe $200 million a year, which well, we won't get into what the comparative efforts are in Wall Street to earn $200 million, but I think I have to tell them about Roy Tolles a little bit on this. Roy Tolles, for example, Charlie's partner, many years ago, decided he was going to want to buy a house in San Marino. He's going to have a number of kids. So he sent his wonderful wife, Martha, out, and for 6 months he had her look at houses in San Marino, and this was many years ago, and if they were priced at $150,000, she would offer, he had her offer $75,000, and of course the real estate agents were going crazy because they were going to get something listed at $150, sold at $75, and then finally, when she found one that they both really liked, he had her offer something like $120, and the real estate agent was so happy to get a bid that was in the general area of the offering price that he would work very hard on the seller to take that bid, because he knew he did not want 6 more months of Roy bidding at the lower prices. So you don't sell them on the first trip. Incidentally, I had Roy buy a house from me sight unseen, because this was a guy that knew human nature. You don't get rich. Real estate agency is, people earn their money, and they earn it in a perfectly respectable and honorable manner in terms of what they get paid. And as in every single industry there is, there can be excesses or mistakes or that sort of thing. But we will continue to buy more brokers. In fact, we'll probably have another couple to announce before long. And we will feel that if we get to where we're doing 10% of the real estate brokerage business in the country, and we're making $600 or $700 million a year pre-tax, we will not think that's a crazy amount of money to make for enabling 10% of 5 million people to change their homes every year in the United States. Charlie?
Well, the commissions in real estate may get unreasonable if you're talking about $20 million houses. It seems a little ridiculous to pay a 5% commission on a $20 million transaction. But do any of us really care if the kind of people who pay $20 million for a house have a slightly higher commission? The ordinary commission is pretty well earned.
Yeah, we have a number of brokerage firms. So the highest has their average transaction in one section of the country would be close to $600,000 a unit, but in terms of the sales price of the house. But in most of our real estate operations, the average price is more like $250,000 or something in that area. And you can show a lot of houses to make one $250,000 sale, and of course you split the listing company and the selling company are usually two different companies. So it does not strike me as excessive, and incidentally, it doesn't strike the people in the industry that way either. It has not been particularly susceptible to online type substitution or something of the sort. The real estate agent earns their commission in most cases, but Charlie's had more experience with $20 million houses, so he will comment on that area.
Hi, I'm Teresa Ligozinski. I'm from Omaha, Nebraska. And I have a question about Microsoft. You have gotten into the tech world with buying Apple. You have Mr. Gates there. I'm just wondering why you've never bought Microsoft.
Well, in the earlier years, it's very clear. The answer is stupidity. But since Bill has, particularly since Bill has joined the board, but even earlier than that, because of our friendship, it just would be a mistake for Berkshire to buy Microsoft, because if something happened a week later, a month later, in terms of them having better earnings than expected or making an acquisition, anything, both Bill and I would incorrectly, but would be a target of suggestions and accusations, perhaps even, that somehow he had told me something or vice versa. I try to stay away from a few things just totally, because the inference would be drawn that I might have talked to somebody about something. So I've told the fellows, that Ted and Todd, for example, that there are just a few things that are off the list, because there'd be a lot of people that wouldn't believe us if something good immediately happened after we bought it. And of course, to buy a lot of stock, you can take 6 months to buy it or something of the sort. We just don't need it. But both that and my stupidity have cost us a lot of money. It's a good question, and I think the answer makes sense. But Charlie?
Well, it's part of theology that a late conversion is better than never, and you've greatly improved yourself.
All right, this question comes from Dave Shane. He says, Warren, you are a big believer in the U.S. political system, the financial system, and in every American. You've said that regardless of who is president, the economy and the U.S. consumer will continue to prosper over the long run. All that said, do you believe that people in this country are more divided today than 50 years ago, or is it just social media and media in general that blows this divide out of proportion? And if you do believe the divide has grown, what words of wisdom do you have to possibly help remedy it?
Now, I would say this: multiple times in my life, people have felt the country was more divided than ever, and I've gone through periods where people I knew and admired thought that because the other party was in power, that there never would be another election, that the Constitution would be. I've heard everything. Now, the interesting thing is, this paper from 1942, since then, there have been 14 American presidents. Just since my young venture into the stock market at 11, I've lived under 14 of the 44 presidents the United States has had. Now, they call Trump 45, but they count Grover Cleveland twice. So there's really only been 44 presidents of the United States. And 14 of the 44 have been during this period when that $10,000 became 51 million. 7 have been Republicans, 7 have been Democrats. 1 has been assassinated, 1 has resigned under pressure. It works. if you'd told me at the start, that you'd have a Cuban Missile Crisis, and you'd have nuclear weapons, and you'd have a panic in 2000, financial panic, and you'd have many recessions, and you'd have war in the streets in the late 60s from a divided country, you'd say, why the hell are you buying stocks? And through it all, America in fits and starts, but America really moves ahead. And we survived the Civil War. I mean, I hate to think of having to do it that way, but this country, in only less than 3 of my lifetimes, if you go back 3 of my lifetimes, you go back 263 years, I guess, and Thomas Jefferson is 12 years old, and that's just 3, and there was nothing here. You've flown in from all over to Omaha today, and you flew over a country with more than 75 million owner-occupied homes and 260 million vehicles and great universities and medical systems and everything. And it's all a net gain in less than 3 of my lifetimes. So, and we've had these events since I started buying my first stock. This country really, really works, and it always will have lots of disagreements. And after every election, you'll have people feeling the world is coming to an end, and how could this happen? And I remember my future father-in-law in 1952. He wanted to have a talk with me before his daughter and I got married. So kind of reluctantly, I sat down with him, and he said, Warren, he said, there's just one thing I want to tell you. He said, you're going to fail. He said, the Democrats are going to get in, they're going to take over the country, and you're going to fail, but don't feel responsible for it because it's not your fault. I mean, he wanted to absolve me from this feeling that while his daughter was starving to death, it was my fault. And I kept buying stocks and doing a little bit better all the time. And if the Republicans were in, it was okay, and it was because of them that I was doing well. And if they were out, forget it, it was all going to disappear. So I've seen a lot of American public opinion over the years. I've seen a lot of media commentary. I've seen the headlines. And when you get all through with it, this country has 6 times the per capita GDP growth, the GDP per capita that it had when I was born. One person's lifetime, 6-for-1 change. Everybody in this room essentially is living better in multiple ways than John D. Rockefeller Sr. was, who was the richest person, in the world during my early years. And we're all living better than he could live. So this is a remarkable, remarkable country, and we found something very special. I would love to be a baby being born in the United States today. Charlie, you give the other side of this.
Well, there's a tendency to think that our present politicians are much worse than any we had in the past. But we tend to forget how awful our politicians were in the past. I can remember a prominent senator arguing with an absolute earnestness that mediocre people ought to have more representation on the United States Supreme Court.
Yeah, he came from Nebraska, incidentally.
He came from Nebraska. So we're not quite as bad as that yet.
Hey, Warren, Charlie, thank you again for having us and having me. I just can't thank you guys enough and appreciate you guys enough for the body of work that you guys have delivered to us and the exemplar example that you guys have set with your principles. Thank you. Charlie, you've mentioned that if given the chance, or the same chance with a smaller capital base, you would still look for mispriced stock opportunities.
Of course.
And that would be determined through obviously what we call the intrinsic value of the organization or the company in question. an aggregate of the discounted future cash flows. Would you work the arithmetic using a fictional data set to illustrate the mathematical principia to determine an intrinsic value? And I'd hope you include the comprehensive mental model of the key metrics considered, any qualitative assessments of the management, and any assumptions of its industry to determine the durability of its earning power. And Warren, same to that effect, would you also demonstrate or illustrate an arithmetic problem set using with a significant capital base and provide the object lessons on how those have changed from a small to a large capital base?
Well, I can't give you a formulaic approach because I don't use one. And I just mix all the factors, and if the gap between value and price is not attractive, I go on to something else. And sometimes it's just quantitative. For instance, when Costco was selling at about 12 or 13 times earnings, I thought that was a ridiculously low value just because the competitive strength of the business was so great and it was so likely to keep doing better and better. But I can't reduce that to a formula for you. I liked the cheap real estate, I liked the competitive position, I liked the way the personnel system worked, I liked everything about it, and I thought, even though it's 3 times book or whatever it was then, that it's worth more. But that's not a formula that anybody, if you want a formula, you should go back to graduate school. They'll give you lots of formulas that won't work.
This is the longest we've ever gone in the Berkshire meeting without Charlie saying that, getting to the point where he prefers Costco to Berkshire. Okay, Andrew.
We got a handful of questions relating to Apple. This is a bit of a mashup of a couple of them. Warren, you have bought in and sold out of IBM. You have praised Jeff Bezos but never bought Amazon. And you have doubled down on Apple. Can you tell us what it is about Apple? And given your sometimes critical views on buybacks, do you think Apple would do better spending $100 billion on buybacks or buying other productive businesses the way you have generally preferred? $100 billion is a lot of money.
I used to think so. Apple has an incredible consumer product, which you understand a lot better than I do. Whether they should buy in their shares, they shouldn't buy in their shares at all unless they think that they're selling for less than they're worth. And if they are selling for less than they're worth and they have the money and they don't see an acquisition that's even more attractive, they should buy in their shares. And I think that that's because I think it's extremely hard to find acquisitions that would be accretive to Apple, that would be in the 50 or 100 billion or $200 billion range. They do a lot of small acquisitions. And I'm delighted to see them repurchasing shares. Let's say we own 250 million or so shares. They have, I think, 4,923,000,000 or something like that. And mentally, you can say we own 5% of it, but I figure with the passage of a little time, we may own 6 or 7% simply because they repurchase shares. And I find it, if you got an extraordinary product and ecosystem and there's lots to be done, I love the idea of having our 5% or whatever it may be grow to 6 or 7% without us laying out a dime. I mean, it's worked for us in many other situations. But you have to have some very, very, very special product, and which has an enormously widespread ecosystem, and the product's extremely stable. And they're not going to find $50 or $100 billion acquisitions, that they can make it remotely a sensible price that really become additive to that. And they may find it, who knows? But there certainly, as I look around the horizon, I don't see anything that would make a lot of sense for them in terms of what they'd have to pay and what they would get. Whereas I do see a business that they know everything about, and where they may or may not be able to buy it at an attractive price when they repurchase their shares. That remains to be seen. Incidentally, that's one thing that I always enjoy. People say, well, you're talking your book or something if you talk. From our standpoint, we would love to see Apple go down in price. They're going to, well, just put it this way. If Andrew and Charlie and I were partners in a business that was worth $3 million, so each of us had $1 million interest in it, if Andrew offered to sell out his 1/3 interest at $800,000 and we had the money around, we'd jump at the chance to buy him out. I mean, it's so simple. But people get all lost, and if he wanted $1.2 million for it, we wouldn't pay it to him. It's very simple math, but it gets lost in all these discussions. And of course, like I say, Tim Cook can do simple math, and he'd probably do very complicated math too. So we very much approve of them repurchasing shares. Charlie?
I think generally speaking in America, when companies go out hell-bent to buy other companies, they're worth less after the transaction is made than they were before. So I don't think you have a general weight of wealth for American corporations to go out and buy other corporations. Averaged out, it's a way down, not up. And I think that a great many places have nothing better to do than to buy in their own stock, and nothing as advantageous to do as as buying in their own stock. So I think we know pretty damn well what's going to happen to Apple. They'd be very lucky if there was something available at a low price that they could buy. I don't think the world's that easy. I think that the reason these companies are buying their stock is that they're smart enough to know that it's better for them than anything else.
That does not mean we approve of every buyback at all, though. I mean, we've seen.
No. Yeah. I think some people just buy it to keep the stock up, and that, of course, is insane and immoral. But apart from that, it's fine.
Warren, if we look at the performance of your equity investment portfolio the last 3 to 5 years, some of the strongest performances come from Visa and Mastercard, which put up returns that were 3 to 4 times greater than American Express. Unfortunately, your holdings of the two names, which we assume were held by Todd or Ted, have accounted for less than 1% of stock holdings on a combined basis the past 5 years, while American Express has tended to be a top 5 holding, accounting for 10% of the portfolio on average and closer to 8% of late. Given that all three firms benefit from powerful network effects along with valuable brands, were there any particular reasons Berkshire did not ramp up its stakes in Visa and MasterCard to more meaningful levels, especially during those years when American Express was struggling? After all, you've shown a willingness to own several stocks from the same industry, holding shares in several competing banks and buying stakes in all 4 domestic airlines in fairly equal amounts when you picked them up in late 2016.
Yeah, when Ted and Todd, or either one of them, I won't get into which one of them specifically bought, or for that matter, they could both have bought Visa and MasterCard. They were significant portions of their portfolio, and there was no embargo or anything on them owning those stocks because we had a big investment in American Express, and I could have bought them as well, and looking back, I should have. On the other hand, I think American Express has done a fabulous job, and now we own 17 and a large fraction percent of a company that not that long ago we may have owned 12%. We've done it without spending time and without, it's a company that has really done a fantastic job in a very competitive field where lots of people would love to take their customers away from them, but they have more customers than ever, and they're spending more money than ever. The customers are, and the international growth has accelerated. The small business penetration is terrific. It's really quite a business, and we love the fact we own it. Like I say, it didn't preclude me from in any way from buying Master, Charger, and Visa, and if I'd been as smart as Ted and Todd, I would have. Charlie?
Well, we would have been a lot better in all of our stock picking if we could do it in retrospect. But at the time, we have a big position in American Express, and there is one tiny cloud on the horizon of the payments processors, and that is the system of WeChat in China. And so it isn't as though there isn't a little cloud somewhere off in the, and I don't have the faintest idea how important that cloud is, and I don't think Warren does either.
No, payments are a huge deal worldwide, and you've got all kinds of smart people working in various ways to change the payment arrangements.
To destroy what we have now.
Sure. And you've got some very smart people that that are building a company, and American Express made a decision a few years ago not to bid as low as somebody else did to retain the Costco business. And I think Charlie and I disagree on this, but I think it was a smart decision. He doesn't think it was a smart decision, but one of us will be right. And one of us will remind you that they were right. But if you look at American Express, it's a remarkable company. I mean, they came after them with Sapphire last year. People want that business, and payments are changing, and you can see in different countries different ways things are going on in that. And there are a lot of people that will play the game of gaming the system and switch from one to another based on the rewards on this card or that and all of that sort of thing. But there also is I think there's a very substantial group for which American Express does something very special, and they keep capitalizing on that premier position with that group, and they're doing it successfully around the country. And you'll see in the first quarter, you've seen in the first quarter, we're in Britain and Mexico and Japan, you're seeing gains of 15% or better in local currencies, and the base is not tiny, but it's not huge, so there's a lot of room left to go in that, and the small business penetration is good. The loan portfolios behave sensationally compared to really just about anybody. So I like very much our holdings of American Express. The first half, because of the accounting changes, they had to suspend their repurchase program for 6 months, but they've announced that they expect to renew it, and someday we'll even, we'll own a greater percentage of American Express, and it'll be a bigger company in my opinion, and I think we'll do very well. But as Charlie says, nobody knows how payments for sure comes out, and nobody knows how autos for sure come out. And that is true of a great many businesses we're in, and we've faced it before. We used to buy things that were certain failures, like textiles and second-rate department stores and trading stamps in California. Now we just face things that face real difficulty, so we're actually moving up the ladder. Okay, station one.
My name is Daphne Kalir Starr. I'm 8 years old and live in New York City. I've been a shareholder for 2 years, and this is my second annual shareholders meeting. Berkshire Hathaway's best investments on which the company built its reputation have been in very capital efficient businesses such as Coke, See's Candy, American Express, and Geico. But recently, Berkshire has made really big investments in a few businesses that require huge capital investments to maintain and that offer only a regulated low rate of return, such as Burlington Northern Railroad. My question to you, Mr. Buffett, is could you please explain why Berkshire's largest recent investments have been departed from your old capital-efficient philosophy? And why specifically have you invested Burlington Northern instead of buying a capital-efficient company like American Express?
You're killing me, Daphne. Yeah.
I'm certainly glad she's not 9 years old.
Yeah. I'm just sitting here thinking which of the 6 panelists we're going to bump next year and put you in. Well, I thought I was doing well when I bought that city service at 11. The answer is that we always prefer the businesses that earn terrific returns on capital, like a See's Candy when we bought it, or a good many of the businesses, and American Express, earns a terrific return on equity and has for a very long time. The fact that we buy a Burlington BNSF, Burlington Northern, means that essentially we can't get more money deployed in capital light businesses at prices that make sense to us. And so we have gone into more capital intensive businesses that are good businesses, but wouldn't it be wonderful if we could run the railroad without trains and track and tunnels and bridges and a few things? We get a decent return on the capital intensive businesses. We bought most of them at very decent prices, and they've been run very well since we bought them. We still love a business that takes very little capital and earns high returns and continues to grow and requires very little incremental capital. We can't deploy as much money as we have in doing that, and so is the second best choice still a good choice? The answer is yes. It's not as good as the best choice. Charlie?
Well, yes, I like the aspiration of that young lady. She basically wants a royalty on the other fellow's sales. And of course, that's a very good model. And if everybody could do that, why, nobody would do anything else. The reason we're satisfied with our utility returns and our railroad returns is they're quite satisfactory. Quite satisfactory. I wish we had 2 more just like them. Don't you, Warren?
Yeah, definitely.
So the answer is they're good enough, and you're asking us to get perfection. If you want us to have all our money in Coke at, say, 5% of what it's now selling for.
Yeah, and a business like Apple really doesn't take much capital, but it's still, you've got to spend a lot of money to buy businesses like that. Very few are for sale, and the answer is we have not foregone any opportunity to buy businesses that earn high returns, very high returns on equity capital, or when we could buy them at a sensible price, to buy these other businesses. So they haven't shoved anything else off the table. But you definitely have a job in our capital allocation department. Okay, Carol.
This question comes from Vlad Koptev in Ukraine. He says, capitalization of cryptocurrencies approached that of Berkshire and Apple last year, And clearly, the idea behind crypto will affect conventional banking groups where Berkshire is a shareholder. You always say you didn't go into too much detail to obtain an understanding on cryptocurrencies. So what factors caused you to say that it's a bubble?
Well, generally non-productive assets remain, if you had bought gold at the time of Christ and you figure the compound rate on it, it may be a couple tenths of 1%. It essentially is not going to deliver anything other than supposed scarcity, because you can only mine so many. But so what? I mean, what does it produce itself? The check is a wonderful idea. Just imagine how the world would be without being able to write checks or have wire transfer of funds. But it doesn't make the check intrinsically itself worth a lot of money. And if you said you can't use something called check with a little piece of paper, you'd do something else to transfer money. I think that anytime you buy a non-productive asset, you are counting on somebody else later on to buy a non-productive asset because they think they can sell it to somebody for more money. And it's been tried with tulips, and it's been tried with various things over time, and it does come to a bad ending. I mean, you have a hard time. You can think of raw land. I mean, the Louisiana Purchase was, say, $15 million for 800,000 or so square miles of land. In fact, you're sitting on land that came with the Louisiana Purchase, and so what we paid $20 a square mile, and 640 acres in a square mile, and you're down to 3 cents or something. So that was a pretty good purchase of what was then a non-productive property. But it depends. But it's very hard. You can buy stamps. Bill Gross collected a wonderful stamp collection, and it sold for more money in the end. But it's dependent on somebody else wanting to buy, hoping they will sell it for more money, and so on. And in the end, you make your money out of productive assets. If you buy a farm, you estimate what the crops, what amount per acre of soybeans or corn or whatever may be raised, and how much you have to pay the farmer that farms it for you, and what your taxes will be, and various things. And you make a conclusion based on what the asset itself will produce over time. And that's an investment. When you buy something because you're hoping tomorrow morning you're going to wake up, and the price will be higher, you need more people coming into it than are leaving. And you can get that, and it will feed on itself for a while, and sometimes for a long while, and sometimes to extraordinary numbers. But in the end, they come to bad endings, and cryptocurrencies will come to bad endings. And along with the fact that there's nothing being produced in the way of value from the asset, that you also have the problem that it draws in a lot of charlatans and that sort of thing who are trying to create various sorts of exchanges or whatever it may be. It's something where people who are of less than stellar character see an opportunity to clip people who are trying to get rich because their neighbor's getting rich buying this stuff that neither one of them understands. It will come to a bad ending. Charlie?
Well, I like cryptocurrencies a lot less than you do. And so, to me, it's just dementia. And I think the people who are professional traders that go into trading cryptocurrencies, it's just disgusting. It's like somebody else is trading turds and you decide I can't be left out.
To the extent that we're being webcast around the world, I hope some of our stuff doesn't translate very well, actually. Okay, Gary.
Hi, Mr. Buffett and Mr. Munger. My name is Kevin, and I'm from Shenzhen, China, currently studying finance and philosophy at Boston College. I have a rather broad question. In this more and more globalized world, What do you think our younger generation can do to best leverage our background and experience of both China and US to create values and further benefit two countries' economy and relationship? And what do you see valuable in a person with a multicultural background? Thank you.
Well, I think in answer to the last question, I think it's terrific to have a multicultural background. And if I never was any good at languages, but if I were in college today and in either country, I'd be learning the language of the other country, because I think it'll be a great advantage over time. Well, I'd start with being multilingual. I mean, certainly in terms of, obviously you want to be able to express yourself in both. And the better you can understand, obviously, the culture of another society, obviously that's a benefit. But I think the market system, modified as it may be, both in China and in the United States, the way it really does, there will be an invisible hand to some extent that does work to improve the lot of future generations by the fact that both China and the United States and the rest of the world is improving. I mean, it is much better, in my view, particularly in a nuclear world, but it's much better to have people prospering throughout the world, partly through their own efforts, but partly through their interactions with the rest of the world. And we've made a lot of progress in that respect, particularly since World War II. I mean, it was a terrific idea to have the Marshall Plan, instead of behaving like we did after World War I and getting the result that we got. I think we made much more intelligently after World War II. So I'm bullish on the future of the United States, but I'm bullish on the future of China and to a significant extent, the rest of the world. People are going to be living better 10, 20, 50 years from now, and I don't think that's something that can be stopped even. Charlie? Absent weapons of mass destruction.
Yeah, well, the multicultural stuff, it wouldn't do you much good to be fluent in both English and Chinese if you were, say, a proctologist in China or a proctologist in Nebraska. So if you're going to use your multicultural background, you've got to work at some interface between the United States and China. And you can raise money in the United States and invest it in China like Li Lu does, or you can be some kind of an importer or a trade specialist. But you got to get near that interface to benefit from bilingual and so on.
But you would bet that the interface will be substantially greater.
Huge.
Yeah.
Huge.
And that's what you want to prepare for.
Yes, and I think that generally speaking, when you get multicultural, you can also be multidisciplinary. But generally, I think people make more money if they're very narrowly specialized, like the proctologist, and that it's much harder to make a lot of money for most people if you try and imitate Warren and me.
I'm glad I didn't meet him earlier. I mean.
My name's Adam Bergman with Sterling Capital in Virginia Beach, Virginia. I'm here with my daughter, Michelle, from Cape Henry Collegiate in Virginia Beach.
Hi, Warren. Hi, Charlie.
Our question for you is how you go about attempting to forecast the degree of future success of one specific product in a good business versus another, such that you invest in American Express and Coca-Cola rather than Diners Club or RC Cola, for example. Thanks.
Well, with American Express, it was an interesting situation because Diners Club got there first. I think American Express, in a certain sense, I mean, they did it for a lot of reasons, but they went into the credit card business because they were worried about what was going to happen to travelers' checks. And although traveler's checks are still exist in a significant way. But the interesting thing when American Express went into competition with Diners Club and with Carte Blanche, as I remember, that was also existed at the time, was that instead of charging less than Diners Club and going in figuring they were going against an established guy and they'd come in at a lower price, they went in at a higher price, as I remember. And the American Express Centurion was on that card. I've got one that I got in 1964, but they were in it before that. It had more value in time. I mean, it got better representation. And frankly, if you were a salesperson out with somebody and you could pull out that American Express card with that Centurion, you look like it were J.P. Morgan. And if you pull out the Diners Club, it had a whole bunch of flashy signals. You look like a guy that was kiting his checks from one month to the next. And a fellow named Ralph Schneider and Al Bloomingdale developed the Diners Club, and they were very smart about getting there first, but they weren't smart about how they merchandised it subsequently. RC Cola, you know, it did. There are all kinds of colas that came after Coke. I mean, you know, you go back to 1886 and come up with something at Jacob's Pharmacy that's incredibly successful. You know, fairly soon you're going to get lots of imitators, but Coke really is the real thing. And you know, you offer me RC Cola and say I'll give it to you at half the price of Coca-Cola in terms of drinking it. I mean, this is a product that's 6.5 ounces, sold for a nickel in 1900. You know, and now if you buy it on the weekend and buy it in large quantities and everything, you're not paying that much more. This newspaper was 3 cents in 1942. You know, the amount of enjoyment per real, in terms of the real of what you pay for this, has gone dramatically down in inflation-adjusted money. So it is a bargain product. You know, you have to look at See's Candy. You know, if you live in California and you were a teenage boy and you went to your girlfriend's house and you gave the box of candy to her or her mother or father and she kissed you, you know, you lose price sensitivity at that point. No? That's so we really want products where people feel like kissing you, you know, rather than slapping you. It's an interesting thing. I mean, you know, in effect, we're betting on the ecosystem of Apple products, but led by the iPhone. And I see characteristics in that make me think that it's extraordinary. But I may be wrong. And you know, so far, I would say we've been right on American Express and Coca-Cola. American Express had this huge salad oil scandal in 1960, happened in 63, November, right around the time Kennedy was shot. And there was really worry about whether the company would survive, but nobody quit using the card. Nobody quit using the traveler's checks. And they charged a premium price for their traveler's checks. So there are things you can see around consumer products that sometimes can give you a pretty good insight into the future, and then sometimes we make mistakes. Charlie?
I got nothing to add, except that if we'd been offered a chance to go into Coca-Cola right after it was invented, we probably would have said no.
We'd have turned to them. Yeah.
It would have looked kind of silly to us.
Well, unless we drank it. Now, Charlie, listen. No, he's right. I mean, we don't foresee things that we haven't got a lot of evidence in on. I mean,
No.
we want to see a lot of, if we're talking about a consumer product, we want to see how a consumer product behaves under a lot of different circumstances. And then we want to use something, actually, there was a book by Phil Fisher written around 1960 called Common Stocks and Uncommon Profits. It's one of the great books on investing. And it talks about the scuttlebutt method of investing, which was quite a ways from what Ben Graham taught me in terms of figures. But it's a very, very good book. And you can learn a lot, just by going out and using some shoe leather. Now they call them channel checks now or something like that, but you can get a feel for some products, and then there are others you can't, and then sometimes you're wrong, but it is a good technique. It's an important investing technique, I would say that. And Ted and Todd do a lot of that. And they have some people that help them out on doing it too. Charlie's done it with Costco. I mean, he is, all the time, he is finding new virtues in Costco, and he's right, incidentally. I mean, Costco has an enormous appeal to its constituency. They surprise and delight their customers, and there is nothing like that in business. You have delighted customers, you're a long way home. Okay, Becky.
Hi, I'm Brady Ritchie from St. Louis, Missouri, shareholder since 1996.
Terrific.
Warren, you and Charlie have been critical of business schools in the past and what they teach. With respect to value investing in Super Investors of Graham and Doddsville, you featured the returns of many great investors with different backgrounds, work, and education, with the lesson being following the philosophy is the key. To be successful today, does it still just fall back to Chapter 8 of The Intelligent Investor? And what do you think of programs and designations such as CFA, CFP, etc., which purport high standards, yet rooted heavily into academia? And I'd like to challenge you to a round of bridge tomorrow.
I went to 3 business schools, and at each, I found a teacher or two. I went to one specifically to get a given teacher, but each one of them I found a teacher or two that I really got a lot out of. So we're not anti-business school here at all. We do think that the priesthood, say 30 years ago, for example, in terms of, or 40 years ago, in terms of efficient market theory and everything, they strayed pretty far, in our view, from the reality of investing. And I would rather have a person, if I could hire somebody among the top 5 graduates of number 1, 2, or 3 of the business schools, and my choice was somebody that was bright, but had Chapter 8 of The Intelligent Investor. Absolutely, it just was natural to them. They had it in their bones, basically. I take the person from Chapter 8. This is not, what we do is not a complicated business. It's got to be a disciplined business, but it does not require a super high Q or anything of the sort. There are a few fundamentals that are incredibly important, and you do have to understand accounting, and it helps to get out and talk to consumers and start thinking like a consumer in many ways in certain industries and all of that. But it just doesn't require advanced learning. And I certainly, I didn't want to go to college, so I don't know whether I would have done better or worse if I'd just quit after high school, and read the books I read and all of that. I think that if you run into a few great teachers and they really change the way you see the world to some degree, you're lucky, and you can find them in academia, and you can find them in ordinary life. And I've been extraordinarily lucky in having great teachers, including Charlie. I mean, Charlie's been a wonderful teacher. And any place you can find somebody that gives you insights into things you didn't understand before, maybe makes you a better person than you would have been before, that's very lucky, and you want to make the most of it. If you can find it in academia, make the most of it, and if you can find it in the rest of your life, make the most of it. Charlie?
Well, when you found Ben Graham, he was unconventional, and he was very smart. And of course, that was very attractive to you. And then when you found out it worked and you could make a lot of money while you're sitting on your ass, of course, you were an instant convert. And so...
It still appeals to me, actually. I mean...
But the world changed. Before he died, Ben Graham recognized that the exact way he sought undervalued companies wouldn't necessarily work for all times under all conditions. And that's certainly the way it worked for us. We gradually morphed into trying to buy the better companies when they were underpriced instead of the lousy companies when they were underpriced. And of course that worked pretty well for us. And Ben Graham, he outlived the game that he played personally most of the time. He lived to see most of it fade away. I mean, just to find some company that's selling for 1/3 of its working capital and figure out it could easily be liquidated and distribute $3 for every dollar of market price. Lots of luck if you can find those in the present markets. And if you can find them, they're so small that Berkshire wouldn't find them of any use anyway. So we've had to learn a different game, and that's a lesson for all the young people in the room. If you're going to live a long time, you have to keep learning.
Yeah.
What you formerly knew is never enough. So if you don't learn to constantly revise your earlier conclusions and get better ones, why, I always use the same metaphor. You're like a one-legged man in an ass-kicking contest.
Yeah. If anybody has suggestions for another metaphor, send them to me. Graham, incidentally, one important point, Graham was not scalable. I mean, you could not do with really big money. And when I worked for Graham Newman Corp, here he was, the dean of all analysts, and he was an intellect above all others around that time. But the investment fund was $6 million, and the partnership that worked in tandem with the investment company also had about $6 million in it. So we had $12 million we were working with. Now you can make adjustments for inflation, but and everything. But it was just a tiny amount. It wasn't really scalable. And the truth is, Graham didn't care because he really wasn't interested in making a lot of money for himself. So it had no reason to want to find something that could go on and become larger and larger. So the utility of Chapter 8 in terms of looking at stocks as a business is of enormous value. The utility of Chapter 20 about a margin of safety is of enormous value. But that's not complicated stuff. Yeah.
I finally figured out why the teachers of corporate finance often teach a lot of stuff that's wrong. When I had some eye troubles very early in life, I consulted a very famous eye doctor. And I realized that his place of business was doing a totally obsolete cataract operation. They were still cutting with a knife after better procedures had been invented. And I said, why are you in the great medical school performing absolute obsolete operations? He said, Charlie, it's such a wonderful operation to teach. Well, that's what happens in corporate finance. They get these formulas, and it's a fine teaching experience. You give them the formula, you present the problem, they use the formula. You get a real feeling of worthwhile activity. There's only one trouble, it's all balderdash.
Yeah, whenever you hear a theory described as elegant, watch out. Right. Okay, Andrew.
Hi, Warren and Charlie. Thank you for everything. I'm David from Kingo Global, an investment manager in Shanghai. I've been here for 8 years. If investment's a sport in the Olympics, you are our champion team. So my question is, facing the fast-growing machine intelligence, how would you see the new competition impact the capital allocation productivity in the future? For Charlie, what is the first principle of capital allocation from general economic interest point of view? Thank you.
Well, two questions. Machine intelligence. I'm afraid the only intelligence I have is being provided by something that's not a machine. And I don't think I'm going to learn machine intelligence. If you ask me how to beat the game of Go with my own intelligence, I couldn't do it. And I think it's too old for me to learn computer science. Generally, I think that the machine intelligence has worked. After all, a machine now can beat the best human player of Go. But I think there's more hype in that field than there is probable achievement. So I don't think the world is going to be changed that much by machine intelligence. Some, but not hugely. And what was the other question?
Well,
one was machine intelligence.
I think he was getting at capital allocation.
Oh, yeah. Well, that's such a general question. Generally speaking, we're always trying to get the best, to get something that's worth buying. And the human mind rejects that if you're in academia, because you could come in and make one declaratory sentence at the opening of the semester and you wouldn't have anything to do for the rest of your time. So people want to find some formula. It's what I call physics envy. These people want the world to be like physics. But the world isn't like physics outside of physics. And that false precision just does nothing but get you in trouble. So I would say you've got to master the general ideas, and you've got to work to improve your judgment slowly, the way all the rest of us had. And I don't think most individuals have much hope of individual gain from machine intelligence.
No, I don't. I'm impressed when machines beat Go or something of the sort, or even win the chess or whatever it may be. I don't really think they bring much to the table in terms of capital allocation or investing. And then I may be missing something entirely. Maybe I'm just blind to what's out there.
You're missing a lot of very remunerative fee-earning twaddle.
Yeah, well, that takes care of that. So we'll go on to station 8.
Mr. Buffett and Mr. Munger, thank you very much for hosting the meeting. It's truly been remarkable. Thank you. My name is Yan, and I'm a partner at Tiger Brokers, a leading electronic brokerage firm from China. Let me rephrase that. So, I and my colleagues flew half away from the globe with IT and fan talks to be here, and it's honored, just like everyone else in the stadium, we're honored to be here. My question is, you mentioned earlier that investors don't really have to be struggling in picking the right stocks. They would do well in picking probably the right market or the right country. China is the second largest economy and probably has the biggest growth potential. Just by passively weighting a portfolio, by passively evaluating a portfolio, US investors are significantly underweighting China. So in your opinion, what are stopping the investors from investing in China? Thank you.
Well, I think the answer is that you're absolutely right, that American investors are missing China, and they're missing it because it's a long way away. It looks different. They're not used to it. It's complicated. The headlines confuse them. In other words, it just looks too hard sitting in Omaha to outsmart the Chinese market. But I think you're absolutely right. It's where they should be looking.
Okay. Ken? we've actually had a couple of investments in China. We've done pretty well, but there were, well, if you go back a number of years, one of the better in terms of getting a lot of money into something, many billions, and we have to get billions into things to move any kind of a needle. That can be tougher in markets that you're unfamiliar working in, and it's difficult under any circumstances. But accumulating a $6 or $8 or $10 billion position in investments outside the United States can be very difficult. For example, in UK and much of Europe, we have to report when we own 3% of a company. In fact, we can be asked to report if we even have less than 3%. That really gets very tough when we get a bunch of followers and a lot of publicity that probably isn't deserved in terms of what we're doing in the markets and everything. So some of the problems are just by the nature of our size. It would be it'd be a lot easier for running a smaller fund. PetroChina, we managed to get a very big position, but the government owned 90% of it. So we bought 14% of what the government didn't own, but it was still only 1.4% of the company. But Charlie actually keeps pushing me to do more in China, and we've tried a couple of times actually. And there was one operation that we got involved in.
Well, you did so poorly the first time you put in 200,000 and got about $2 billion. So
yeah.
wasn't encouraging enough.